these are, even though you see all of this down here and you see all of this up here, this is just a lot of noise. If you look at a moving average, it's a lot easier to look at. And so this is typically, when it's moving down like this and you cross over sort of this sort of midline here, that means there's a lot of calls being bought. When this moving average is moving lower, it means calls, calls, calls over puts, more calls. But if you remember what I said, when everybody and their sister is long, and I mean everybody is long, you get an extreme reading of the put-call ratio, extremely high call ratio versus puts, which you would not really be able to see that well if you didn't have the moving average. Now, can you see all of this and all of this, all this green? Like, I guess you could, but look how clearly you can see it when you put a moving average on it, right? So much clearer to see. And when it starts getting anywhere near 0.6, 0.65, 0.6, like in this range, that's extreme. And that's typically when a top is formed in the market. So this chart on the bottom here is the S&P 500. So look at this. Beautiful, great structure, happy to be long, happy to be long. There's a lot going on right here. What's going on here? This was in July of 21. I'm sure that you could look at some of the other indicators that we talk about, but specifically this one, you can see how the put-call ratio gets extended to the call side here. A top is put in, and then down she goes. And as it goes down, as the markets flush, you'll see this moving average go up. What does that mean? It just means more. Look at this. Boom, 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 boom. It means more puts are being bought. But once you cross over this line and start heading to this extreme, wow, you are way extended. And this typically means that a bottom is put in. And that's when the algos kick in, dump puts, and start buying calls. And stocks gets bought by institutions and hedge funds. And then the retailers eventually catch up. And then what happens? You rally. As you rally, more calls are being bought. So you see this start to drop. But then it starts to dip past this line. You form a little topping pattern here. Other indicators, VIX, yields, dollar, JP Morgan, Apple, Nvidia, other things kick into gear. And what do you know? Sell off. When it sells off, what do you see? Puts being bought. Look, boom, 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 boom. Up, and you're starting to get a little bit extreme. Now, in this instance, it fought it anyway. And even though you got a little bit of put action, it kind of reversed right away. And more calls got bought, more calls got bought. And the markets went higher and higher and higher and higher and higher. So this just happens like all the time. And every once in a while it glitches and you don't see it kind of setting up too accurately. But for the most part, how interesting is this chart that I'm showing you right here? I wouldn't call it parallel KSA only because, or a mirror image, only because that would create a bias in your mind that it's always that way. You always have to look at every chart, every indicator, every candlestick, every market as if it's the first time you're seeing it. Without a bias, well, when that happens, I know this happens. Not always. You need confirmation with other things. But it is interesting. And I'm sure you guys have never seen this quite before. This is a 5-period moving average. How interesting that the 5 SMA, or do I have EMA? Not that it matters. I think I have simple. Yeah, simple. The 5 SMA on the put call ratio is nearly the inverse of the S&P 500. Do you guys find that interesting? I do. I think that is wicked cool, which is why. And if I did VIX and SPY, you'd see something similar. If I did yields and certain stocks, you'd see something, like XHB, IYR, certain industries, maybe even XLP, XLV, healthcare, consumer products, high dividend stocks. You'd see that relationship. If I showed you the dollar in relationship to commodities, metals, gold, silver, if I showed you the VIX as it compared to just the big cap stocks, just big caps, now you're starting to see the basis or the foundational principles of the market weather that nobody else out there was putting together. And that's what made the difference for me, was when I put them all together in one sort of market weather report. It gave me an indication of where the markets were going to be going. And then I needed a methodology to control my spending. That's called allocation. And I needed a trading plan so I would know, well, if it's working, I'm going to add to my position. If it's not, I'm going to exit. I'm going to scale out. I'm going to come up with unique strategies so I'm not just buying calls and puts. So I spent a lot of time researching verticals and butterflies and different combinations of them that would work.
Thanks for watching. Hope you enjoyed this video from Trade With Me Now. Make sure to go ahead and like this video and subscribe to our channel so you make sure that you catch our next video right when it's released. Also, if you have a question or comment, please leave that in the comment section below. And of course, if you want to learn more about Trade With Me Now or join our community of profitable traders, go to tradewithmenow.com. There's also a link in the description below.